For a look at what the data means for the economy ahead of the Fed's critical two-day meeting next week, let's welcome Stifel Chief Economist Lindsey Piegza. Thanks for joining us. Any change to your viewpoint given what you just heard Rick and Steve talking about, Lindsey?
Well, I think this morning's monthly numbers really enforce what we saw from yesterday's quarterly GDP report, that the economy remains solid, driven by ongoing resilience from the consumer. But when we look at inflation, that is still the problem for the Fed. We're seeing prices are still very sticky. And while they are coming down, the level of disinflation or the momentum of disinflation is significantly below what the committee would like to see. And so from this standpoint, despite ongoing volatility in the market or ongoing one-off disruptions in the banking sector, the Fed has their eye entirely on that proverbial ball of inflation, reinstating price stability. That is their first and foremost concern. Not only is May already in, as mentioned, but it's very likely that the Fed will feel pressure to continue to raise rates in June and beyond until they reach a sufficiently restrictive level where it's convincing that the inflation data will continue to trend lower and lower back to that 2% target.
So how does it work? Okay, so we go 25 basis points. Then, as you say, then maybe we go another 25 basis points. Now, exactly how is that going to work to address the core problem with inflation? Where is that core inflation coming from? And how does a couple of 25 basis point increases cure that? Connect the dots for me, because
we have two sides of inflation. The Fed is focused on destroying the demand side of inflation. All of those stimulus dollars, all of that additional appetite for consumption, raising the cost of borrowing, raising the cost of capital, that taps down investment, that taps down consumption, that slows the economy potentially into a downturn or an outright recession, as the Fed now has priced into their base case in the second half of the year. That will result in a slowdown in the demand side of inflation. However, the second question is, once we reach that sufficiently restrictive level to get the demand side of the inflation equation under control, what happens to the supply side? If supply side variables keep price pressures elevated, the Fed won't need to continue to raise rates, but they will need to keep that level of Fed funds at that terminal level for much longer than the market is anticipating.
If it's a supply side problem from the very beginning, and a lot of people would argue that it is, then this is totally misguided in the wrong way to try to get inflation under control. And
absolutely, but it's from both sides. It's the demand and the supply side of the equation.
If you're raising interest rates across the board on people, that's inflationary for the people that have to pay the higher interest rates. So it almost can make it worse. Why not? I don't know. I guess the Fed is not in the business of increasing supply, but I would think more people employed means wage pressures go down because there's more people that are in the labor force, so they aren't able to ask for money. I can almost make an argument for every single thing that the Fed is doing that the opposite, that their actions actually can make it worse.
Well, remember, we also have millions of Americans that are still sitting on the sideline. So by raising the cost, again, of capital, you incentivize some of those sideline workers to come back into the marketplace, and that could add to the supply of labor, which thus puts downward pressure on wages.
Then you got wage pressure.
You have downward wage pressure, downward, because you're increasing the supply of labor. And at the same time, if you're curtailing investment, businesses will suffer layoffs or closures altogether, which puts downside pressure on the demand side. So again, what you're trying to do is equalizing the labor market, which right now has a sizable disconnect between supply and demand. That's what the Fed is trying to focus on. But the supply side of inflation coming from international factors, that's where the Fed has little control.
Think about it. I mean, the pandemic ended. How much of this it might not be stimulus checks, which were also a result of the pandemic? I mean, it all seems like it's related to that, and may not be anywhere close to what caused it back in the Volcker era. It could be a totally different reason why this is happening, and the old antiquated way of trying to deal with it might be, at best 30% effective for what the Fed's trying to do, and so you get a hard landing, and I don't know. There's a lot of room for error, isn't there, Lindsey?
There certainly is a lot of room for error, but I would caution that the larger risk is that the Fed doesn't raise rates high enough and allows inflation to become entrenched in the economy. If the Fed overshoots, the Fed will recognize that shortly thereafter and can cut rates to help stimulate the economy again. But again, the bigger risk is that the Fed loses its resolve to continue to raise rates because of maybe one-off market scenarios.
It's not coming from oil.
And that will leave.
It's not coming from oil. It's not coming from commodities. It's not.
Look
Where's
at
it
the
coming
first
from?
quarter GDP report. Consumption remains very robust, and you're talking about nearly 500 basis points of increase. So
then it's
clearly,
wage
the Fed
pressure.
raising rates. Well, how do we solve wage pressures? We solve
that's what you're
wage
saying.
pressures
That's where it is.
either by decreasing the demand for labor or increasing the supply of labor, both of which the Fed is trying to tackle by raising rates. It's a
that's
slow
where you think
process, and it's a very blunt instrument.